Walk us through your reaction to JPMorgan's results this morning.
No surprise at all after those results. We see this as raising the issues that we've been raising with our clients now for months. High inflation, supply chain constraints, uncertainty in markets, a lot of volatility, followed by, of course, we expect a 50 basis point rate hike, so certainly a rising rate environment. So all of those indicators, and as well as the geopolitical shock, of course, all of those indicators are something we've been noting for some time. I'd say I actually took not a bearish indicator out of some of that telegraphing that Jamie Dimon did, but a rather more sanguine indicator. They're putting assets in reserve. They're expecting credit losses. We have to remember in the last cycle, we saw nowhere near the defaults that analysts had forecast. There was certainly an extend, pretend, a desire not to force companies into default. So we didn't actually see those losses happen. I think this has been done out of an abundance of caution. I would also note that the buybacks is a robust signal. And also remember that JPMorgan is a diversified financial services firm. We saw very strong results come out of BlackRock. They're seeing sustained inflows and a continuing growth of their asset management business across all asset classes. So even though their total assets under management took a hit from the Russia-Ukraine situation, that's very robust. Most banks now have an asset management arm, and that has been a great source of upbeat inflows and earnings.
Aoifinn, you referenced the previous cycle. The previous cycle, we didn't have a big inflationary problem, so the Fed could step back in. The Fed put was still active. This time round, it's not. Judging by what we got from Barkin and Bullard overnight, they are talking about raising rates effectively until they break the economy. They're talking about restrictive policy, significantly restrictive policy. That is the difference between this cycle and the last. Are they really comparable?
I think we have to look at similarities across the both. What would have happened in a previous cycle when risk was off? There might have been a flight into safety assets such as cash. That can't happen today. Cash destroys purchasing power today. So therefore, that provides some kind of put in its own right. I've noted before the large amount of assets in money market funds. Money market funded assets have soared since the pandemic, and they've actually stayed quite flat. So that in itself is really a put on markets. The fact that investors will continue to seek return in an environment where real returns after inflation are continuing to fall. And we're also looking at statistics that investors are not that leery of bond markets today, even with a rising rate environment. They see that if they're buy and hold investors, their fixed income will still come good. We saw some headlines yesterday around investment grade bonds, perhaps hitting around 9% yields. We haven't seen these kind of yields for years, for decades. So actually, if there was a yield like that, that might actually quite support markets. So it's a very complex picture, but definitely the high rates of inflation are something all investors have to pay attention to when they think about taking risk off.
You mentioned purchasing power. My ears immediately perked up because something that we've really seen as a legacy of the pandemic and really the surge and record issuance that we've seen from a lot of corporate America has been extreme profits. We were just talking to Shonali about buybacks and record buybacks for the S&P 500. Talk to us about the cash picture at a time when a lot of people are saying inflation is going to erode that purchasing power, like you mentioned. Does that mean we should expect more buybacks, more mergers and acquisitions, more deployment of that capital, even if that means more CapEx?
Certainly, most companies are awash in cash, and those that have got some kind of pricing power have been able to pass through price increases to consumers. I'm not sure that will be sustained. We do expect to see margins come under some pressure as there just isn't that ability to pass through prices and consumers start to feel the pinch. But yes, I do see that most companies are quite cash rich. They haven't been investing in CapEx. Perhaps they need to do that to alleviate some of their supply chain constraints, maybe to integrate a supply chain, to buy some vendors. But ultimately, we will see that that purchasing power, I think, will remain robust, particularly among the retail investor.
Aoifinn, equities remain an inflation hedge if they can pass that inflation on to the consumer. Are you confident that they will be able to continue to do so?
Yes, I am, to a degree, not to the kind of levels we're seeing today. 8% price rises cannot be sustained. The consumer cannot support that when they're not seeing their wages match that in terms of an increase, and they're also not seeing, for example, their residential property rise. We saw close to a 20% rise year on year. That makes the consumer feel buoyant. We're not going to see that same level of increase. So the consumer won't have the same confidence. They will be seeing the price increases at the pump and their gas. They'll be seeing it in their grocery bill. So I don't see that companies will retain that pricing power going forward, no. But yes, to a smaller degree, low single digits, yes.
I think you hit on a really crucial point here that you will see this essentially hit consumer pockets, but there is a difference between slowing down growth, demand destruction, and then an outright recession. Are the fears of an outright recession, specifically in the United States, overdone? What's your thought?
We would say yes, they're overdone because of the tight labor market currently. We're not looking at a stagflationary environment because the demand for labor is simply so strong. So much of the workforce have fallen away, are not participating any longer. The picture might be different in Europe. And there perhaps will be a slowdown. We do see GDP growth slowing to single digits, but whether that will occur in 23, 24, 25, it's very difficult to say. And investors cannot simply go to cash now in expectation of a recession. We saw that JPMorgan was hedging its bets essentially, or preparing for the worst. And what should we do? Well, we can't go to cash because that is essentially destructive right now.